Investors respond to uncertainty by doing nothing. Hence, the transaction volume has been very low. Businesses respond to uncertainty by holding on signing a new lease. And so that has happened in many cases. Some businesses have said, it's not really going to affect us. Let's go ahead. We've seen a lot of the major law firms and accounting firms leasing a lot of new space in New York and the premium class A stuff. It's incredible what's been happening there.
Hi, Adam Gower here, founder of GowerCrowd.com and host of this podcast YouTube show, Real Estate Market Watch, current events through a real estate lens. Now, my guest is Professor Glenn Mueller of Denver University. Glenn has been producing the real estate cycle monitor I think, for the last 30 years, very long time, where he analyzes what stage of the market each asset class, real estate asset class, is in across major markets across the United States. So today we're actually getting quite a treat because his Q1 2025 report is not out yet. I will coincide this podcast's publication for the same time as the report, as Professor Mueller's report comes out. But you're going to be getting a personal walkthrough with Glenn of that report. So it's very interesting. And he also talks about some forecasts about where he thinks various asset classes and markets will be going in the coming months. So this is an extremely important episode if you are considering where to be placing your capital. Professor Mueller has been doing this for a very long time, and especially with some of his forecasts today, you get some good insights into what areas are growing, what areas are in decline, and what areas are stable. Okay, if you've not already signed up to the accompanying newsletter for this podcast and YouTube series, please go to GowerCrowd.com. There's a big subscribe button there. Sign up. You can always unsubscribe, or subscribe, I should say. You can always unsubscribe. But I do provide some analysis of what my guests are talking about. And for today's podcast, I will also include a link to the latest market cycle report from Professor Mueller. All right, so that's all at GowerCrowd.com. All right, let's move on to our conversation with Glenn Mueller, a professor at Denver University, who's going to give you a little background about the market cycle report, as well as going through the next one, yet to be published, but very soon to be published. Here he is. Glenn, it's a great pleasure to see you again. You've been on my podcast a few times. I'm an enormous fan of the market cycle monitor report that you put out regularly and have been doing for a while. Why don't you start off by telling me, if you would, please, how long you've been publishing it, actually what it is, how long you've been publishing it, and what is your research methodology?
Sure. I started it back in 1992 when I was working at Prudential Real Estate Investors, so 33 years worth, and carried it with me to all the different companies and universities that I've been at. And it's currently available on the University of Denver site, as well as the charity that I work at called Sharing Connection, which does affordable housing financing help, etc., like that. And the methodology is literally the fact that demand and supply for real estate is very different in each city. And demand and supply, when you combine those two together, will tell you what kind of occupancy levels there are. And that's really what the cycle report does, is look at occupancy levels, and occupancy levels drive rent growth. It doesn't say anything about prices or transactions. That's a whole nother thing that really comes from capital flows in the market, how many investors are out there. But occupancies and rent produce the income in real estate, and that's what I focus on.
Right, and you actually publish two versions, don't you? You publish one for the general public, and then there's a premium one that looks forward. So you have a backward-looking one and a predictive one, correct?
Right. Well, as you say, backward is as of a point in time. So currently, I'm just in the process of finishing the first quarter of 2025. Uh, I know the quarter ends at the end of March, but it takes the data providers a month to get all their data together and that kind of stuff. So at the end of April, I get it. And here we are just about mid-May, and I'm working through everything. I will be showing you the new cycle slides. I just haven't finished the report write-up yet. So
Okay,
should
well,
have
I'm
that next Monday.
definitely looking forward to that. And I am going to ask you, and of course you can decline if you like, but if there are any forecasts that you'd like to share at some point, I'd be delighted to hear them. But so what are the latest highlights? I know you wanted to share your screen. So if you want to go ahead and do that, we can have a look at some of these slides now.
Yeah,
So Professor Miller will go through these slides. He'll describe them for anybody who is not actually watching this on YouTube, but who is
right.
like me listening.
So I'm going to pop off here to make sure that everything comes through clearly.
Okay.
I assume you can see the slides okay at this point.
Yes, sir. I can see that's fine.
Great. Okay. So again, I'm now retired, but professor emeritus at University of Denver, still teaching one class. Burns School is the second oldest real estate school in the country, um, and we also have a program for wealthy families, family offices called the Bailey Family Enterprise Program, where I'm the academic director, and then I'm at a nonprofit called Sharing Connection with an X, where we help to finance and develop affordable housing. We help charities um, to actually ingest real estate. Many charities won't take real estate as a donation, so we handle that type of thing for them. And then we also do something we call real estate rescue. When a charity is renting property and the owner decides to sell, we will buy it, let them take time to raise the money so that they can own it themselves outright. Um, so I think everyone knows that the real estate markets go through cycles, and the three key things that drive demand are population growth, and we still are growing at 0.7%, or about 3 million people a year. And that population growth is expected to slow here with less babies being born and with slower immigration happening. From, as you can see here, historically, back in the early 2000s, 3.2 to 2010 to 2020, 2.3, and then the forecast is about 1.9. But the key number one thing for demand for real estate really comes from employment growth. And you can see it was 1.3, then 1.4, and now about half of that going forward at 0.6. And the reason for that is more mathematics of more and more baby boomers like me retiring, and the number of people coming out of school and getting their first job still growing, but not quite as fast as the people retiring. So it's still a positive number, and I think that's one of the keys with all the turmoil and everything we've been hearing and the economy slowing down. What we really need to focus on is the fact that employment growth is still strong and unemployment is very low. So that still continues to drive demand for real estate.
Okay.
So as we look at costs, obviously inflation is the big one, and currently we're running higher than this. This, by the way, these are 10-year forecasts that come from the Congressional Budget Office. They're the only people that do a 10-year forecast because they need that to model out any kind of legislation that they're working on. So we expect it to be back, or now I'm going to say I think they'll be revising this soon to a little bit higher number, probably closer to a 3% number. And I know that the Federal Reserve's target has always been, 2%, but I think that may be a little unrealistic, in the future of the world, and maybe something closer to 3 would be better, in which case they should potentially drop interest rates. And as you know, over the last from 2010 to 2020. We had an extremely low interest rate environment at 2.4% with the 10-year Treasury. That was less than half of what it was from 97 to 2010. And the forecast right now, we know the 10-year Treasury is running probably right about 4.234%, and Congressional Budget Office had it set at 3.8. I think it's going to hover around 4, honestly, going forward. So that doesn't mean totally bad times because 97 to 2010 were good times in real estate as well. Okay. And you have to remember that the economy goes through cycles. Here are uh, both GDP and employment growth overlaid on each other. You can see that expansion periods normally go between 5 and 10 years. Recessions are very short, anywhere from 6 months to kind of the longest being a year and a half in 28, 29, in 2008, 2009. And, again, a short but sharper and deeper recession with COVID.
Mhm.
And then the forecast, at least currently, is still for positive growth by a majority of the economists out there today.
Okay.
So I'm going to actually skip over these and go right into my thing. As I talk at different cities, I talk about their economic-based industries that make things grow. I just came back from teaching at Wharton. Um, and you can see here that utilities and professional and scientific and technological, education services, healthcare, and arts and entertainment are the big drivers of growth for Philadelphia. But let's go ahead and start talking about market cycles.
Okay.
Um, I break it down into two parts, the physical market cycle, and that literally comes from the paper that I published back many, many years ago in 2003. Um, and it's very local in nature. Demand and supply drive occupancy. So demand comes from the employment in the city and the economic-based industries that are making it grow. So if the auto industry is booming, Detroit, Michigan is going to do well. Occupancy drives rent growth. If occupancies are high, rents rise faster. If occupancies are low, they can be or dropping, rents can go slow or negative. And when you think about it, if I increase my occupancies and I increase my rent, I get income growth, and that's half the total return analysis in any investment decision that you'll ever make. Okay, so
Okay.
if we look at history, my first study looked at um, 30 years of cycles from 1968 to 1997. You can see that I have laid it out into 16 points on the graph because a typical real estate cycle lasts approximately 16 years. In the recovery phase here at the bottom, you see negative rent growth at the bottom when everybody's got too much space to let out. It starts to grow. And when it gets to the long-term average, zero point 0.6 year on the cycle, it's growing. It historically grew at 4%. And then it grew faster in the growth phase, in the expansion phase here, and hit the highest growth rate at 0.10 at 12 and a half. And then at the peak occupancy, which is really equilibrium where demand and supply are growing at the same rate, it was 11%. And then it started to slow down or decelerate, 10, 6, back to kind of 3.3, and then low and negative at the bottom. And by the way, that 4% was about the rate of inflation during that 30-year time frame. Now, if we go and look at the next 23 years, what you see is, again, same thing, negative at the bottom, slow coming up. And if you remember the previous number, inflation was running about 1.8 and rent growth was 1.7. Stronger than inflation rent growth all the way to the peak, with a 10.3% at the peak, and then again decelerating and slowing down and going low and negative at the bottom. So knowing where you are in the cycle can be very important for making decisions. Do I buy or sell? Do I try to hold up for a higher rent? Do I lease for as long as I can to take me through the next down cycle, etc.? So you now have the first look at the at what's happening in my cycle, first quarter of 2025. Basically, industrial and retail at their peak, hotel about halfway through the expansion phase. Industrial warehouses, on the other hand, a little bit of hypersupply because of the overbuilding post-COVID. Apartments on the way down, not because there's not great demand. We are 6.5 million housing units short in the United States today, and we need both houses and apartments to fill that. But we built a lot of really nice Class A downtown apartments for the millennial generation, and and raised rents to the point where they can't afford it. So we have some oversupply from that standpoint. And of course, office, due to the COVID problems, both downtown and suburban, sitting at the bottom. But let's break it down here and look at it by city. And what you see is, while the national average is at the bottom, different cities are doing very well. Norfolk, Virginia, a military base and a resort town, at peak because it literally hasn't built much in the last few years, and therefore it sits at the peak. Honolulu doing well. Again, a place where it's very hard to build anything new. Um, Riverside, California at point 0.9, over, if you will, the Inland Empire in California. Actually, occupancies improved and it moved up in that space. Whereas San Francisco, it's one of the highest cost cities in the country, with a lot of tech jobs leaving to go to lower cost cities over the past 5 or 6 years, is sitting at the bottom, as are most other California markets. New York City was over here at point 16, if you will, looking like it was turning down, but now you probably all read the news that the premium Class A in New York is doing very well and filling, and those premium Class A buildings are sitting at close to 95% in occupancy, whereas the B and C office space in the city is not doing well, but it actually improved, and the outlook is now positive going forward as opposed to negative on the downside. Compare that to Washington, D.C., which is near its bottom, but it looks like more people leaving, especially with the government selling off some buildings and that type of thing. As we move into industrial, you'll see about half the markets at their peak occupancy, a number of them in hypersupply over the top, again, mainly because of overbuilding and the demand from internet retailers slowing about a year after post-COVID. We think that'll settle out, and all of these could easily jump back over into the expansion phase, and possibly that may be happening in 2026. If we look at apartments, again, the really high cost cities, all those occupancies are at a peak occupancy, including San Francisco, by the way. And then the markets where there has been more overbuilding are either in the hypersupply or the recession phase. Okay. Looking at retail, some people are probably surprised by this, but basically pretty much every retail market in the country is at their peak occupancy. And that's because over the last decade, with the internet sales rising, retail new construction has been extremely slow. And even though demand has been slow, supply has kind of matched into that, and therefore we are at peak occupancies, and we'll see a little bit more of that later here in a minute. Okay. Then hotels. It is a really bifurcated market. You see that a majority of them are in the expansion phase, points 6 to 11, with a few lagging behind and and trying to come up. But remember that we had a couple of things. First of all, business travel pretty much shut down altogether. And then travel for vacations, etc., boomed, especially right after COVID, as people had sat home for a year, didn't get to take a vacation. So we were calling that revenge travel. Hey, I didn't get to take a vacation last year, so I'm going to take two this year. So demand really, really grew from that. And The other thing that has come back very strong here in the last year or so is conference travel. So business people getting out to meet with each other, et cetera. But until people are fully back in the office, going to see them is a little bit harder. And thus, so the business part of this is what is kind of holding off there. So let's just take a step back in history and look at demand, supply, and the dynamics that have happened over time.
Okay.
And what you see is that back in the 1970s, we had a strong, or we had a demand rate of about 2% with a supply rate, the black bar, of about 5%, and more supply than demand, and occupancies fell. But starting in 1975, 1976, all of a sudden we had the kind of the start of the what we would call the information age and using computers to do analysis, et cetera. So demand for office really started to grow and started growing at a faster rate than than supply, and therefore occupancies picked up during that second half. And in 1979, occupancies hit a peak of 95% or a 5% vacancy rate. That low rate caused developers to think that they could build anything. And you probably have heard of the field of dreams,
Right.
build it and they will come. And so in the 1980s, you'll see that supply grew at an average rate of 7.7% over that decade. And what's somewhat incredible about that is that we basically doubled the amount of office space in the United States in one decade. And 80% of that new construction was in the suburbs. We created suburban office markets in the 1980s. Whereas demand, the yellow bar here, grew at a rate of about 3.8% or a little less than half of the supply. Therefore, we had a full decade of occupancies dropping during that time frame. But the most incredible thing about this graph is that if you remember, population back then actually was growing at a rate of about 1%. And the baby boom generation, me, were coming to work for the first time. And so employment was growing at 1.6% or 60% higher than population growth.
Mm.
But demand for office is going at 3.8. That's more than double the rate of employment growth. And the main reason for that is that the United States changed its economic base. Back in 1960, 30% of all people working worked in the manufacturing industries. And today we're down to 8% working in manufacturing.
How many? Sorry, how many? You said 30. I thought you said 3%, but you meant
30, yeah,
30%.
30% of people were working in manufacturing in 1960.
Hmm.
Office using jobs back in 1960 were 8%
Hmm.
of all jobs. Whereas today we are at 30% of people in jobs that use offices. So we have moved from being a manufacturing country to being a technology, information economy. So a big change, if you will, over the last 40 years or so.
Hmm.
Okay. Moving on to the 1990s, that oversupply of the 80s basically shut down new construction to less than 0.5% here in 92, 3, and 4, whereas demand continued to grow at an average rate of right around 2%. But the nice thing was by 1998 and 1999, demand and supply were matching up, which would put us at that peak point 11 in the cycle. Okay. And since 2000 to 2010, you can see again supply running about 2.5%, dropping to around 1, and then picking back up a little bit. Demand decently strong in 2000. Then the technology bubble burst in 2001, and first time ever negative demand for office. Picked right back up to over 2% in '05 and '06, dropped back down, and during the Great Recession went negative again for the second time ever in 2009. And so you can see here the lag too of supply picking up and demand picking up a few years after, or demand dropping and supply taking a few years to drop off because it takes, you know, 3 years to get a office building built in the suburbs and 5 to 8 in any downtown in the country. Okay. 2010 to 2020, first half up through 2016, more supply, more demand than supply. So a nice increase in occupancies. Then supply starts to outstrip demand. And again, 2020 with COVID created again a third negative demand growth for office space that really hurt. And then going forward, and by the way, notice that the graph here is now down to 0 to 1%. And going forward here, we're looking at the stuff that was started pre-COVID finishing itself out in 2003 and four and dropping to less than 0.5%, and hopefully demand picking back up because it is actually up. Um, office or office using jobs are up, but whether or not companies will lease the same amount of space is really key. So let's actually look at what's happening here.
Okay.
And you can see the red line, office occupancy very high in the early 80s, bottoming out by with a little bounce, bottoming out by 1991, peaking again to a high peak equilibrium in the year 2000, dropping with the technology bubble bursting, a low equilibrium peak in 2006 at only about 91.5%. Bottoming out in 2010 with the Great Recession at around 89, and then a moderate peak of about 93.5% in 2020, and COVID making it drop off and continuing to do so, we believe, over the next few years. But you can see that rent growth literally follows the occupancy cycle, and the correlation between occupancies and rents is actually almost 80%. So very strong there. If we look at and I've got if we jump now and look at my forecast for office, you can
Okay.
see that not much has changed from the first quarter of 2025, but my forecast for 2026 is that Riverside will continue to improve a little bit. Most of the markets still sitting at the bottom, with a couple places like Minneapolis, Salt Lake, St. Louis, and Kansas City moving up either 1 or 2 spots. That's what the numbers are behind them, and improving their occupancies. Orlando doing well, Miami backing off a little bit, type of thing. If we look at industrial, you see basically the same kind of cycle. Um, Peaks in occupancy back in 1990, or excuse me, in 1995, and again in 2000. A real bottom in 2010 with the Great Recession, a peak in 2019, slight drop with COVID, another peak in 2023, and now that fall off from new supply coming on. And rent growth staying pretty positive. The black line here is the average of 92% for industrial over time, and it lines up with zero rent growth there. And you can see that we had really strong rent growth of 2.5% here back in 2020, and now it's running in the 1% range. Okay. And so my forecast for industrial, again, a few cities moving around, but pretty much everything hanging in similar spaces to where it has been in the past. Apartments, real estate follows the economy. You can look at the occupancy level moving up and down over time in the same fashion. The post-COVID spike in occupancy at 95.5%, which is only 2% above the long-term average of about 93.7. And rent growth didn't set these up the same. The zero line's way down here, but pretty much positive rent growth all the time. And again, these are quarterly numbers. That's why it's so jagged in here. And then my apartment forecast, again, everything pretty much hanging where it has been. A few cities that had overbuilt now starting to pick up, like Austin, Texas, and Jacksonville, Florida. The high cost market's still sitting at their peak occupancies over that time frame. Okay. And then retail, again, everybody's sitting at the top, literally no movement.
This one actually is an extraordinary chart because this is the only one. Oh, actually, except for East Bay, San Francisco, but the only one where everybody is at equilibrium, with the exception.
Except for East Bay and San
Yeah,
Francisco, yes. And I'm
right.
sorry, I jumped past. Let's look at the retail graph here. You can see that retail used to have peaks of 94, 94 and three quarters, almost 95, right? And then just pre-COVID, it was up to 96, dropped off during COVID and peaked again at 96.4%. That's the highest occupancy as you can see over time. So retail has been a constrained supply situation across the country, and demand is there. 80% of all new retail being built is already pre-leased. In other words, someone has come to a builder or developer said, I really need this, please build it. I'll sign a lease now so you can go get your financing. So that has been a big deal in retail.
Okay, before you move on from this slide, so there is fair consistency between rent growth and occupancy, except in this last period here. What's going on? Why do you think that rent growth isn't quite as aggressive? You would expect it to be stronger,
Right.
wouldn't you, with the highest ever occupancies?
Right. Well, I think the part of the reason for it is that retail has had profit squeezing going on, and therefore, and a lot of the old retail that uh, was vacant, people are leasing at lower numbers. So that's an average. Brand new retail is going for higher rents, but existing older retail is leasing out at some pretty low numbers. So that's kind of the reason for that.
Okay.
And then if we look at hotel, you can see it rising from 60 to 65% pre-COVID, dropping to almost 35% in during COVID. And today we are running above that, pretty close to 70%. There are some new retail I mean, some new apart, some new hotels
Hotel. Yeah.
coming online because of it. And so we will see how travel goes if inflation hits and people are worried about inflation and those types of things. We may see that, or a recession, we may see that back off. And so again, the forecast looks like cities that are spread all over the map. Um, but most of them again in the growth phase. And so we still see some rent growth there. So that's the income side of the story. Now let's move to the financial cycle, or it is capital flows that drive prices. Just like when people are confident and they think things are good and there's not much risk in the air, they will buy real estate. When there's uncertainty and a lot of risk, they stop buying. And if we look at real estate compared to other investments, you've got the stock market equities at 26 trillion, the bond market at 39 trillion, and US income producing real estate at 18 trillion, or 22% of that pie. That does not include home ownership, either single family homes, condos, or anything else.
Okay.
And one of the things that you have to remember is when we look at the income market or bonds, which is the largest category, the 10-year Treasury over the past 70 plus years has had an average yield of 5.8, and today we're running about 4.2. So we're still below that long-term average. And also realize that when you buy a bond, if you don't keep it to maturity and you sell it, its price can go up or down. And so as interest rates rose from 1953 to 1973, the total return, even though the yield on them started at about 3 and went to the long-term average of 5.8, was only 1.9% because as interest rates go up, bond values drop. And the total return from 1953 to 1981, 3.9% because and literally the 10-year treasury hit its peak of 15% back in 81 because those bond values have dropped. But as interest rates have come down since 81 for the past 40 years, we have a total average return of 8.6%. And so bottoming out here literally during COVID at 0.6%,
Hmm.
okay, in um, in 2020, the lowest ever seen, and working its way back up, the return isn't as good. Okay, so here is if you will, the capital flow, these orange bars of real estate over time, and then the blue line is the commercial property price index or CPPI from Moody's, and you can see that as trading volume, transactions pick up, price picks up. When that falls off, prices drop. And you can see it move up and down. And so since 2022, as interest rates started to rise, we see that property prices have come down. And what I'm going to do is break that down for you. Here is the latest numbers for April. And you can see that the property price index in the month of April dropped by 0.5%, but over the past 12 months, it's up 4.3. So you can see here that we've had this little rise, if you will, in this past time frame.
Hmm.
Okay. And then we can break it down by property type. You can see everything peaking back in 2022, just before interest rates started to rise, and then everything coming down. The top gray line, manufactured housing or mobile home parks, the number one performer, followed by industrial, then self-storage, and then lodging in red, and then, excuse me, apartments ticking up here a little bit. And the worst two are office and regional malls that took their hit post-COVID and have pretty much stayed there since.
Let me ask
Okay.
you, before we move on to the next one, you look at healthcare there. That surprises me. When baby boomers like thee and me start to get up in age, isn't there higher demand for health services? You would think that that would be higher, wouldn't you, in that slide? The one that you were
Well,
looking at.
you have to remember that we have baby boomers as we get into retirement. We don't need, as when you're young and growing, you need to buy cars, you need to buy clothes, you want to buy a house, you want to buy furniture, and us baby boomers, we have all that. And whether we're going to constantly upgrade and renew
Mm,
is something kind of unique and different.
yeah.
So if we look at cap rates here, you can see them coming down as prices rise. And then again, since 2020, since interest rates started, cap rates have started to move back up.
Mhm.
And but the one thing to always look at is how is real estate priced versus the other asset classes? The S&P 500 has a dividend yield of all of 1.5%. And if we take the risk-free rate of the 10-year treasury and look at how much extra you're getting over the risk-free rate, what you
Mhm.
see is that it was running around 400 to 500 basis points back here in 2002, dropped down to about 150 basis points or 200 basis points here in '06, kind of came back up and stayed in that 500 range. And then recently, interest rates have come up, but cap rates haven't risen as quickly either. And therefore, the spread has dropped some, but just picked up very recently. So you're still getting 200 basis points over the risk-free rate for the risk of investing in real estate. Okay. Oops, I got that slide twice. Sorry about that.
No.
And the one thing that's kind of interesting here is that if we look at here's the cap rates, and if we look at mortgage rates, they really took off in 2002, and in 2004, they actually crossed. So it's now more expensive. A mortgage at 6.75 is higher than a multifamily cap rate at 5, which means people are still expecting that they're going to get some income growth and some price appreciation, even though they're buying a property, if you will, with negative leverage,
Right.
or
Except
they're
you do
not buying at
notice
all.
that
So what we
your
have is a lot of cash buyers making that
right,
kind of
your
thing
mouse
happen.
is actually on that last screen actually was masking there is an uptick in cap rates right at the end. It's just
Yes, you can see that uptick here
yeah.
from 4.5 to 5 right
Mm,
at the end of 2003.
mhm,
So um, if we look at the capital flows, who is buying and who is selling. Blackstone, number one, as both buyer and seller in the country at almost $20 billion. Brookfield, again, being a large Canadian asset manager, um, and kind of run down the line here, but these are all the major purchasers of real estate in the country. And you see some names you probably know: J.P. Morgan, Tia Kref, the teacher retirement system. Again, Brookfield there as well.
mm,
And in my now 40 plus year career, when I started back in the 70s, it was a local buyer, a local seller, and a
mhm,
local bank doing the financing. In the 1980s, the institutions, the pension funds and endowments got into real estate. National buyer, national seller, and national financing was available. In the 1990s, REITs, the publicly traded companies, really took off and and bought a lot. And so all of a sudden we had access to the public capital markets for equity, and commercial mortgage-backed securities that literally were conceived of for the first time in 1988 really took off and became 10 to 20% of the financing world. So all of a sudden real estate had access to the public capital markets. But since the year 2000, what we see is that the market has gone global. And so Moody's now watches, and we call these um, uh, what do you call it?
these are the it's not the cross-border capital flows.
Yeah, it's basically
Absolutely
cross
fascinating.
border. So
Yeah.
in 2024, the United States put $11.8 billion into German real estate.
Mm,
That was a 26% increase over the previous year. Whereas number four, Germany,
mm,
came into the United States and put in $5.6 billion or a 1% decrease. And yeah, the one thing you also need to remember here is that anytime you're looking internationally, you have to look at the exchange rate. And
right.
so as the dollar got stronger, other capital looked less, or other markets looked more attractive,
Hmm.
i.e., lower price in terms of dollar,
Right.
whereas United States looked more expensive, hence the slowdown from that standpoint.
Yeah, this is interesting. Actually, just for those who are listening, the biggest investors in US real estate in 2024 are in this order: Germany, Switzerland, Singapore, Spain, and Israel. It's interesting, isn't it?
Yes,
We've definitely seen, I remember the 80s when there was massive, I mean, I don't know what the chart looked like, but massive weighting from Japan into the US. I wonder what it looked like in those days
right.
to 24.
Yes. So it literally changes every year.
Hmm.
So my conclusions here in 2025: economic and real estate cycles can be long or short. GDP, which is our indicator of whether we're going to be in a recession or not, was negative, positive, and who knows? I know it just slowed down a little bit, but in real estate, what we care about is the fact that we still have good and positive employment, and I don't see anyone really forecasting negative employment growth. Um, Market cycles can be driven by demand or supply, and supply growth slowed after 2010, staying under 2%, except in industrial and apartment, helping to keep those in balance. And as you know, we're in the growth phase, in 2025 in a number of property types and property markets still. So, things still kind of looking decent from that standpoint. On the financial cycle, it's capital flows that drive prices. And, the volatile stock market and higher interest rates make real estate potentially look more attractive. Um, We've had black swan events, COVID, bank failures, now wars, now the office collapse, and of course, everybody's waiting for what's next.
Yeah.
Um, and real estate, the best thing to do is find safer tenants, ones that made it through COVID, that aren't going to get hurt terribly by tariffs, right? But the world is still awash in cash, and that drove up prices in 2021 and 2022, and then it stopped with the uncertainty in 2023. But a lot of that cash is still sitting there. Many of these institutional uh, real estate investment firms have raised lots of money um, for opportunistic funds to buy when prices drop. But they may not drop. They may just sit where they are. Um, we've had much more conservative debt financing than we've had in past cycles. Most commercial real estate being only financed at 60% versus historically 75 to 80%, and that potentially averts any new banking crisis. Um, and obviously, higher interest rates and increasing cap rates create a price decline. Um, but the other thing that's pretty unique is that we've seen institutional owners defaulting and giving back keys to lenders on offices.
Yeah.
Here in Denver, are two of our major office buildings that were owned by Brookfield Asset Management, one of the top firms we saw there as a buyer here in 2024. They actually gave the keys back to those two buildings, saying, "We can't see this turning around and becoming profitable for us in the next 5 to 10 years." Okay,
And
but
you've got a triple exclamation point after that comment. Why? What's so unusual about that?
well, when you have a high quality, institutional quality owner of a building
Mm,
walking away from that building, if you will, potentially hurting their reputation, that's a new thing,
mm. Yeah, exactly. Yeah.
right?
Okay.
And in everything we do, we always have to differentiate that homeownership is completely separate. I don't look at that because people don't rent and have occupancies. They own it or they don't,
Mm,
versus income producing real estate. And so that's why I use the term apartments versus multifamily, because people think of
mm.
condos. Homes, condos, townhomes that are owned aren't aren't what I look at. So with that,
Okay, fantastic.
um,
All right, let's go back to video. Do you want to stop the sharing?
okay.
So what kind of impact? Okay, so this is a daft question, but you've been doing this for a very long time. And we have a new government. To what extent is the impact of the current administration having any influence on the commercial real estate market? Where do you think that's going? Of course, the two things that stand out in my mind are, of course, tariffs and the ensuing uncertainty.
Okay. So I don't think that the current administration has any perfect direct impact on income producing real estate. It
Mm,
only has impact on real estate demand. Okay. In other words, we're unsure of where things are going. You know, Trump came up with tariffs because the United States was being treated very poorly by a lot of other countries, and trying to get tariffs into a parity is an interesting thing to do. The other thing is, I don't know if you realize, but basically, the United States government doesn't collect sales tax like other countries have VAT taxes, right?
mhm.
A tariff is basically like a VAT tax, and it goes to
Right.
the federal government instead of state and local.
Mhm.
So it is a way of the government, the federal government actually increasing its revenues. Okay, and our trade imbalance has been bad. In the first year of the Biden administration, there was $427 billion of trade deficit, and with Trump, it's been 37 billion so far, not even 10%. So, I think what we're trying to do is obviously there's a little bit of pain in trying to re, you know, re-rationalize and rebalance, international economics. But I think is a long-term goal that should be very good for real estate in the United States over time.
Uh, okay, and do you consider any of the kind of federal or administration policy decisions when you make your forecasts?
No, I look at and the economic forecast of demand
Mm.
I get from economists, right? And then the federal government numbers that I showed you. So no, I'm a real estate guy
Yeah, no,
through and
me
through.
too. So do you think so there's many or some economists expect a near-term boom driven by industrial policy, tariffs, and reshoring. Do you think that could be a meaningful shift in property demand patterns in the coming years?
Um, the one case is, well, with tariffs, obviously we don't need to be storing as many goods coming from overseas,
Mm.
but we actually had an increase in occupancies once tariffs were announced because people are, well, let's get as much as we can in now before the tariffs start to have that go. And now with today's announcement of, the China tariff being, 30%, which is, extremely low, that's starting to sound much better, right? So this period of turmoil potentially ends up being over here, let's say by the end of summer, maybe, and
Yes,
we're
I'm
back to a normal situation.
How do how do investors typically respond to, again, in your experience, to heightened political uncertainty? And are you seeing any deviations from historical behavior in the current cycle?
So investors respond to uncertainty by doing nothing. Hence, the transaction volume has been very low. Okay. Businesses respond to uncertainty by holding on signing a new lease. Okay. And so that has happened in many cases. Some businesses have said, it's not really going to affect us. Let's go ahead. We've seen a lot of the major law firms and accounting firms, leasing a lot of new space in New York, and the premium Class A stuff has been. I mean, it's incredible what's been happening there. And there are actually two new premium Class A buildings in the development phase with some pre-signed leases. So it's interesting. And another fun factoid, that new supply going to hurt? And I guess part of that answer is I saw Gensler, one of the big international uh, design and architectural firms, engineering firms, has done a study and said about 25% of most office buildings could economically be converted to apartments. So that would help to, you know, balance out demand and supply.
Yeah, and there's some talk about tax credits or some kind of tax
Oh, just about every
credits.
city is doing tax credits
Yeah.
and all that kind of stuff. So yes, I expect to see that taking place, which creates some economic activity as well.
All right, so we've been talking for a while already. Oh my goodness, it's gone very fast. If you don't mind, let me ask you three rapid fire sign-off questions.
Okay.
So for real estate investors, for sponsors out there, professional real estate investors, what are the two or three market signals that you personally watch that give you early warning of the shifts in the industry?
Number one, demand. Is employment moving up or down? And it continues to move up. The fact that, all the economists forecast 160,000, it comes in at 140. Oh, they're so disappointed, right? And then the next month it's over. And if you looked at the whole year, their forecasts and the actuals probably come out. One month does not make, does not make anything. But the I think employment's going to look good.
If you were to advise a professional real estate investor who is sitting on cash today, what would you be telling them to be doing over the next, call it 3 to 12 months through the rest of the year?
Well, everybody's out scouring for great deals.
Mm,
If I were to say what to buy now, if you can find some retail that's pre-leased to a great tenant, you're most likely good to go. If you can build new apartments to market rent in the suburbs, and I don't mean Class A, but the number one demand in this country is for workforce housing or affordable housing,
mm.
right? There's a huge demand up here. We just built here in my mountain community a 160 unit affordable housing project, and they did a lottery because there were 800 people,
Oh my
even
God.
though our community is all of 4,500 people.
Oh my goodness. Oh, that's incredible. It's people wanting to escape the big cities by the sounds of it. They want to come out there for sure.
Right.
Okay, last question. So, are there any political or market developments that you track that you anticipate could give you pause to rethink any assumptions that you have about where we're headed?
I am somewhat apolitical, and they announce they're going to do something and then it doesn't go through. So I don't know. I mean, obviously, we have had the most massive change in political policy in, a century
Mm.
with what Trump is trying to do. And I'm an optimist, if you will, and I think that we're going through a turmoil period now. But if his goals are met, the United States will be in a lot better shape.
Professor Emeritus Glenn Mueller of Denver University, correct?
Yes.
As always, an enormous pleasure. Thank you so much for joining me today.
All right. Thank you.
All right, that was Professor Emeritus Glenn Mueller of Denver University. Glenn, what a pleasure seeing you again. It's always a pleasure. Thank you for your accommodation with the Wi-Fi. Yes, your up and download speeds. It actually turned out exceptionally well and a lot better than many of my guests. So no worries there. Thank you for joining me. Thank you for your time. And thank you for going through the report. I look forward to seeing the final version. As I mentioned earlier, I will include a link to that in the show notes or on the show notes page for today's episode. Thank you too, dear viewers and listeners. If you've not already subscribed to the Gower Crowd newsletter, just go to gowercrowd.com and hit the subscribe button. You'll see some of the companies that some of our subscribers work for. It's quite an interesting list. You'll be in good company and you will get detailed summaries of the conversations that I'm having in this series in that newsletter, all there at gowercrowd.com. Okay, thank you everybody again for joining me and my guest this week. Until next time, this is Adam Gower signing off.